Is the market dying a death of a thousand cuts? I know that seems a little dramatic, but stick with me as I get into the details. My name is Brian Cannon, and welcome to Markets in 5. So I'm going to run through several charts today, and I think you'll start to see what I'm talking about as far as the title "Death by a Thousand Cuts." But you can see definitely now that the S&P 500 is in a downtrend, and so the downtrends will come with very positive upswings and very dramatic downswings. And so essentially, what we're looking for is to make sure that if are we going to break out of this upper channel? If so, we're back on. We're putting our cash back to work. We're putting the risk back on. Market's in good condition. But until then, we're very much in defensive mode, very much in protective mode. But you can see that we are now in a pattern of lower highs and lower lows, and that's not a good sign. So I kind of talked about this red dotted line right here being kind of the line in the sand. And it's real interesting how the market respects that because, we came up, we touched it, we came around, we touched it, broke it, came up, couldn't get back through it with any sort of substance to take out this upper trend line, came down, broke it, had a big day yesterday, but couldn't get back above it. And the futures this morning looked down. So, my initial review of where the market was going to go, if you look here in the orange, from the peak to trough, the initial trough, we had a 12.5% downswing. And so the measured math would take it down to the second red line. So I'm anticipating that's where our next level of support comes into play, maybe sooner than later, and more than likely it'll coincide with this down trending channel here. So there's a lot of problems in the market right now, and again, I know it's tough to kind of sit back in cash and tough to miss out on big days like yesterday. But until we get a major trend up, it's better to play it safe than sorry. But that's not to say that we're all in 100% cash. It just means that we're definitely shifting our positions toward things that are uncorrelated to the market. So in this next chart, you can see a longer term. If we kind of zoom out a little bit, you can see a longer term chart. And so the last major downswing we had was the pandemic in 2020. And you can see where that trend line was taken out and then, lights out. Bottom just kind of fell. It was kind of a waterfall event. So markets react the downswings work in different ways. So for instance, 2020 was just what I call a waterfall descent. And right now, it's just more of a slow, steady, take your money, keep having lower lows, give you a little bit of hope, it falls down again, put more money in, it falls down again. So it's kind of this death by a thousand cuts. It just kind of just destroys you over time, and it just rolls over. So you can also see the blue is the frowny face. You want to sell the frownies and buy the smileys. And so we're nowhere near a smiley right now. So we've got frownies, and that's usually not good. So if we take the same chart and we zoom out a little bit further, you can kind of see the impact. So again, you've got the peak to trough descent of the 2020 pandemic pull down of 36%. Back at the end of 2018, trend lines were broken and there was a 20% drop. So right now we're at about 15% down. And but the trend line's broken. It's not a time to get cute. It's not a time to put a lot of risk on at this point. It's more of a time to pull the risk off and readjust your portfolio to prepare for more downside potential. And so this last chart is a major zoom out. So I wanted to kind of start small and end big, but essentially this takes you all the way back to the end of the 90s. The roaring 90s came to a halt in 2020 when the market had the tech crash, the tech bubble. And so the market gave back 50%. Could you imagine giving back 50% of your assets? That would really suck. And so just as about the time you started to recover and get back to even, the market took down another 57%. So this was a period of a secular bear market where you just couldn't make new highs, and it didn't actually break out till 2013, 2014. But so now we're on this big run up. So again, the pandemic took back 36% and quickly rebounded. So now we're only down about 14-15% right now. So I just want to make sure that I'm not making phone calls to anybody with heartbreaking news that they've given up half their assets. So that's why we do what we do, and that's why we go into protection mode when the red lights are up. So again, not to be too dramatic with the title, but I think you can start to see that the down markets work differently in different situations. Waterfall descents all the way down versus kind of something that just slowly just starts to take your money. And I feel like that's the type of drawdown we're in right now. So we're watching it very closely. If you have any questions, give me a shout, and make sure to subscribe and like this video on YouTube, and look forward to seeing you on the next Markets in 5.